Buying shares for income has become a minefield of late. Companies of all shapes and sizes are cutting or reducing shareholder payouts as their profits sink and their balance sheets feel the strain. Even stacks of FTSE 100 stocks have decided to rebase their dividend policies in the wake of the COVID-19 crisis. But fear not, I am here to highlight what are the best dividend stocks of 2020. Stay tuned to today's video where I reveal all. What is up guys, welcome back to the Capitalist Investor YouTube channel, back with another video. Today's video on hot dividend picks right now is something I'm really excited about. Before we get into the video, a couple of housekeeping items to do first. Number one, disclaimer, I am not a financial advisor and nothing in this video constitutes financial advice. If you require a financial advisor, please seek a licensed professional. Number two, if you are new to this channel, please help support it. Hit the subscribe button and let me know in the comments below what you think of these dividend picks. That being said guys, we can get into today's stock picking episode of dividend payers in 2020. First up, London Stock Exchange Group, ticker LSE. A 1% dividend yield for 2020 clearly isn't one of the biggest out there. But never mind that. The rate at which the blue chip has lifted annual dividends over the past half decade has been truly staggering. And City analysts expect payouts to continue exploding despite the coming economic storm. In fact, the group stands to benefit from these conditions that are deriving turbulence on financial markets. Major buying and selling activity drove London Stock Exchange total revenues 13% higher during the first quarter. London Stock Exchange has a rock-solid balance sheet. It supports its ultra-progressive dividend policy, and I'd happily add to its position in my portfolio in my ISA today. Stock pick number two is Smith & Nephew, which many of you may not have heard before, and it's ticker SN. Smith & Nephew plc, for those of you who don't know, develops, manufactures and sells medical devices worldwide. The company offers knee implant products for specialised knee replacement procedures. Like the London Stock Exchange, Smith & Nephew decided to persist with paying dividends despite the COVID-19 quake. Healthcare related stocks are considered to be some of the safest out there in economic times. And this FTSE 100 giant's decision to maintain its payout policy underlines this theme. That's not to say that the artificial limb maker hasn't had a torrid time of late. Smith & Nephew has seen demand for its high-tech products slump in recent months as the coronavirus outbreak has caused non-essential surgeries across the globe to be kicked into the long grass. This caused underlying revenues at the FTSE firm to crumble 8% in the first quarter. However, with countries having expanded their healthcare facilities to deal with coronavirus patients and global infection rates beginning to slow, Nephew can look forward to a demand for its products gradually picking up again. Indeed, back in early May, the company declared that the recovery in China is encouraging, as is the restart of elective surgeries in many other countries, and especially in the US. Sales in these hot growth regions rocketed 8% and 24% respectively back in 2019, which underlines the exceptional long-term revenue potential of these territories. Smith & Nephew's near-term dividend isn't the biggest either. In 2020, it sits at 1.4%. But like London Stock Exchange, City brokers expect steep rises in the annual payout over the medium term at least. Both have rock-solid balance sheets to support these projections, and this allied with their bright earnings outlooks makes them brilliant buys for income-hungry investors like you and I. Stock pick number three is National Grid. National Grid's results were announced on the 18th of June, and looking at the numbers, I still believe this is a solid dividend pick for income investors. The financial results were not initially great. On Thursday, the grid reported a 1% rise in underlying operating profits to 3.5 billion, but this was slightly below what the market was expecting. It also revealed that the pandemic had hit earnings due to a 117 million increased provision for bad debt from customers specifically in the US. There were positives though. The company stated it had maintained high levels of reliability across its network, and despite warning of a 400 million hit to operating profit in the new financial year from the virus, CEO John Pettigrew also appeared confident that the impact of National Grid's financial performance will prove temporary and largely recoverable over future years. This might explain why the shares were initially down in very early trading, but have since recovered. So, are National Grid's dividends safe? For now it would appear so. On Thursday, the company announced that it would return 32 pence per share to holders as a final dividend. This brings the total cash payout for FY20 to 48.57 pence per share, or a trailing yield of 5.1%. Sure, a 2.6% rise on the amount of cash returned last year isn't massive. However, I suspect existing shareholders won't be too upset. After all, the company had previously said it was adopting a wait-and-see approach to dividends in light of COVID-19 outbreak. The fact that it has now chosen to retain the policy is encouraging, and looking forward, analysts are predicting a 49.9 pence per share return in the current financial year, that being FY21. That gives a chunky yield of 5.3%. The only thing worth highlighting here is that the dividend cover, the extent to which payouts are covered by profits, isn't massive at 1.2 times, and 2 times is generally the ideal place to be. But then again, one might argue that National Grid's earnings are predictable, enough to make this less of a concern. Naturally, nothing can be guaranteed with investing. The coronavirus has simply been another reminder that dividends are never safe. Indeed, they are often the first thing to be shelved when the going gets tough. Nevertheless, I think the company's track record, combined with Thursday's news, makes National Grid a stock that could be held with a lot more confidence than others. It won't give holders thrills and spills, but those are not what dividend hunters are looking for. Based on the current projections for FY21, the stock trades at just under 16 times earnings, which may appear expensive if we compare it to the 5-year average of 13.5. But then again, the relative predictability of National Grid's earnings in the current environment is arguably worth paying up for. All things considered, I maintain that National Grid is one of the best picks from the FTSE 100 for investors wanting to build a diversified income portfolio. That's it for today's video, guys. So my top picks for the best dividend stocks of 2020. We've got London Stock Exchange, Smith & Nephew and National Grid. I currently own 2 of these. To find out which 2, please do check out my portfolio review. I will leave a card up here for it. Please do click on it and check that out. Thanks for watching, guys. I've been the Capitalist Investor. You've been YouTube. And until next time, peace.